Generally speaking, I'm an active investor, and what I mean by this is that I'm willing to go in and out of investments based on their fundamentals and their valuations. I may invest in a specific company because I think that it's undervalued, but if its share price then suddenly recovers and becomes overvalued, I will not hesitate to sell it to redeploy the proceeds into a better opportunity. But there are some exceptions. Some REITs are just so attractive that I plan to hold on to them for the long run. Their properties are enjoying very rapidly growing rents. I expect this to lead to significant shareholder value creation over time. Patience pays off when you own good real estate, and I expect to be very patient with these two REITs. Hey everyone, this is YCHARTS from a small investment firm that specializes in REIT investing, and in today's video I'm going to discuss two REITs to buy and hold for the long run. I call these forever REITs because the best holding period for them is forever. But before I get into the first one, could you please do me a huge favor and click the like button? That will help me a lot to keep on growing. Thanks so much in advance. So the first REIT I'm going to discuss here is called Sun Communities, ticker symbol SUI. This is the largest REIT that specializes in manufactured housing communities, RV parks, and marinas. And these three property sectors just happen to be doing really well because they are strictly limited in supply but rapidly growing in demand. The supply of manufactured housing communities and RV parks is strictly limited because no one wants a new park in their backyard and it's very tough to get new licenses. However, despite the limited supply, the demand keeps on growing because we are facing an affordability crisis, and these parks happen to be the cheapest option for housing. Marinas are a bit different, but once again, their supply is strictly limited because there are only some specific locations that are desirable for them, and there are not many spots that are vacant, but even then the number of boat owners keeps on growing. Therefore, these specific properties are very attractive for long-term investments because they're in a near constant state of supply-demand imbalance, and it's resulting in steadily growing rents. And this is very clear if you look at the past performance of Sun Communities. I'll put a chart on the screen comparing its historic returns to that of the S&P 500, and you'll see that it has vastly outperformed the average of the stock market over the long run. And I think that now is an interesting time to invest in the company because its share price has crashed along with the rest of the residential market, yet it's doing much better than most other apartment REITs. Apartment REITs are today suffering a bit because they're dealing with oversupply, and this is causing their occupancy rates to decline a bit and their rents to stagnate. But if you compare that to the performance of a manufactured housing REIT like Sun Communities, it's day and night. Sun Communities is still guiding for 5% same property NOI growth this year. It's coming down from about 7% last year, but it's still very solid growth compared to most apartment REITs. Its occupancy rate is at near 100%, so clearly it's not dealing with oversupply. And yet, despite performing a lot better, it has dropped in lockstep with high correlation to other apartment REITs. As a result, you can now buy shares of Sun Communities at a historically low valuation, even despite its strong performance. I'll put a table on the screen where you'll see the valuation of the REIT. Today it's priced about 20 times FFO, a small 10 to 15% discount to its net asset value, a small 2.5% dividend yield, but keep in mind that the yield is only so low because the payout ratio is very low at just around 50%. It's retaining a lot of cash flow to keep reinvesting in growth. And here on the surface, these valuations may not seem that low to you. 20 times FFO may seem high to some of you who are used to buying value REITs like EPRA properties at just around 10 times FFO. But here there are three things that you need to keep in mind. Firstly, these are low cap rate properties because they are very defensive. They're dealing with limited new supply, low capex requirements, and steadily rising rents. Secondly, the REIT owns a lot of land that hasn't developed yet, and so it's not generating any cash flow yet, but it still holds a lot of value and will be developed sometime in the future. And thirdly, as you saw in the table earlier, the company has very low debt with a 30% LTV. The lower debt you have, the higher your FFO multiple typically will be. And the REIT is growing its same property NOI at a very rapid pace. Its 10-year average is at over 7%, and that naturally will also justify a much higher multiple. This explains why historically the REIT has typically traded at 25 to 30 times FFO, and even that's not particularly expensive for the company. At sometimes it has been at closer to 35 times FFO even. And if you look at the lowest point of the pandemic crash, back then it traded at 20 times FFO, which is in line with today's valuation. I think it's interesting to note here that the activist REIT investment firm Land & Buildings recently built a large position in Sun Communities, and I think that they are thinking just like us. They are seeing that Sun Communities is trading at a similar valuation as at the lowest point of the pandemic, even as it's doing quite well today, and we think that this is an opportunity. It has been unfairly beaten down by all the negative headlines that are affecting apartments REITs today. Yes, it's true that they are dealing with oversupply, but this isn't the case for manufactured housing REITs. This is a different property sector. And as I discussed previously, this REIT is actually doing quite well, and yet it's today discounted, and that is likely why they've built their position. At High Yield Landlord, which is my REIT newsletter, we invested in the company when it was priced at a roughly 30% lower valuation than this. We got in near the bottom, we got quite lucky, but even today I think it's very attractive, and our plan is to hold on to it for a very long time to come, because we expect its same property NOI to keep beating that of most of its peers, and at the same time, as I mentioned earlier, I also expect it to keep developing more properties, creating more value for shareholders. Hey, before I go into second REIT, I want to remind you that we recently created a free tier to our REIT newsletter, High Yield Landlord. There's a bunch of high quality research there available, including even some CEO interviews. We've recently posted an interview with the CEO of YCHARTS Properties there. So if you want to check it out, it will be the first link in the description of this video. Then the second REIT I expect to hold for a very long time to come is called Rexford Industrial Realty, ticker symbol REXR. This is an industrial REIT that focuses in last mile distribution centers in urban markets of Southern California. It's the leader in this space and owns arguably the best properties in this region of the world. And it just happens to be an amazing property type in terms of supply and demand. The new supply is strictly limited because this area is already fully built out, and there are significant geographical constraints with the sea to the west, the border to the south, and mountains to the east. But the demand for these assets is growing rapidly as a result of the strategic location of Southern California, with its proximity to major ports for international trade, the Mexican border as well for nearshoring, onshoring, as well as the large consumer market of California. Moreover, there are also the growing trends of e-commerce and onshoring, which are only leading to more demand and making the supply-demand imbalance even worse. As a result of all of this is the strongest industrial market in the entire world, with even today a 98% occupancy rate, even as this sector is dealing with some oversupply. The strength of its market is also very well reflected in the past growth in its FFO per share relative to that of its close peers like Prologis, or even the growth of its dividend per share. And I think that today is an interesting time to invest in the company, because during most times it's priced at a very high valuation that reflects the strength of its market and its rapid growth prospects. But today it's exceptionally discounted because REITs have gone through a 2-year-long bear market, and Rexford wasn't immune to it. Its share price dropped by about 40% from its peak, even as it kept growing its cash flow at a rapid pace. As a result, it's today priced at 21 times FFO, down from closer to 30 to 35 times FFO at near its peak. And also here you need to consider that while it's priced at 21 times FFO today, that's based on today's rents, but the lease rates it has today are deeply below market rent, and so as its leases now gradually expire over the next 2, 3, 4 years, it's going to be able to bump up its rents very significantly. The REIT estimates that it could enjoy about 35% bumps as its leases expire, and I think that this, combined with some external growth, could lead to 50% FFO per share growth over the next 5 years. If you now take this into account, the forward FFO multiple of the REIT is actually far lower than the current one. Therefore, I think that as the REIT realizes this growth, the share price is going to have to adjust a lot higher, because otherwise the REIT will soon be trading at closer to 15 times FFO, which just wouldn't make any sense for a REIT of this quality with such rapid growth prospects. Some patience will be required here, because it will take time for these leases to expire and for the rents to be bumped up to higher rates. But if you have the patience, then I think that this is an amazing opportunity to capture above average returns in the coming years. Again, here we got the chance at High Yield Landlord to invest in this company when it was trading at about 20% below today's level. But even today, I think that it remains very attractive. And for this reason, we expect to hold on to it for many years to come. Now, let me know in the comment section below what other REITs you expect to hold on for the long run. And also, if you want to access our full portfolio, please note that we're still offering a free trial for our REIT newsletter, High Yield Landlord. It will give you immediate access to our full portfolio and all our trade alerts in real time. Finally, once more, if you could please do me a favor and click the like button. That will help me a lot to keep growing this channel. Thanks so much for your support, and see you in my next one. Bye-bye.